1. What is day trading? In the vast landscape of financial markets, day trading is a high-intensity endeavor that requires focus, agility, and a sharp understanding of intraday price behavior. It involves the act of buying and selling financial instruments, typically stocks, exchange-traded funds, or options, within the same trading session, with the express objective of capturing short-term price movements. Unlike long-term investing, which seeks to build wealth over years or decades through fundamental value and compounding, day trading is about precision and timing. A professional day trader is not concerned with quarterly earnings reports, macroeconomic forecasts, or corporate fundamentals. Instead, they operate in a world where seconds matter, volatility is opportunity, and discipline is non-negotiable. What sets day trading apart from other forms of trading, such as swing trading or position trading, is the intentional closure of all positions before the market closes. This eliminates overnight risk, unpredictable events that can dramatically alter a security's price before the next session opens. By exiting intraday, the trader ensures that their capital is never subject to after-hours market shocks or earnings surprises. The goal is not to predict the future, but to react intelligently to what the market reveals in real time. Price action, volume, and momentum are the core signals that guide decision-making. Successful traders understand that market behavior reflects crowd psychology more than logic. Fear, greed, hesitation, and euphoria are constantly at play, and those who master their own emotions while interpreting the herd's behavior gain a crucial edge. It is important to note that day trading is not gambling, though it is often misunderstood as such. A professional day trader follows a well-defined strategy, adheres to strict risk management, and treats trading as a serious business operation. Just as a successful entrepreneur tracks revenue, expenses, and performance metrics, a day trader must journal trades, analyze data, and make evidence-based adjustments. The financial barrier to entry has been lowered in recent years thanks to commission-free brokers, powerful trading platforms, and real-time market access. However, accessibility does not equate to profitability. The majority of novice traders fail not because markets are impossible to navigate, but because they lack structure, discipline, and the right mindset. Day trading requires the same level of commitment, continuous learning, and emotional resilience as any demanding profession. It is not a hobby. It is a performance-based career where results are binary. Either you make money or you do not. There are no participation trophies, no guarantees, and no shortcuts. If approached with respect and preparation, day trading can offer flexibility, autonomy, and the potential for financial independence. But those rewards are reserved for those who are willing to pay the price through education, experience, and disciplined execution. Ultimately, day trading is about probabilities, not certainties. You are not looking to win every trade. You are aiming to find setups where the risk is controlled, the reward is favorable, and the odds are in your favor. When done right, day trading is not reckless. It is calculated, methodical, and deeply rooted in risk management. 2. Traits of a successful day trader. Success in day trading is not determined by intellect alone, nor by access to capital, luck, or the speed of your internet connection. While technical tools, trading platforms, and market data serve as essential infrastructure, they are not what separate winners from losers. At the core, the difference lies in the trader. More specifically, in the traits they cultivate and reinforce through disciplined practice. To trade for a living is to treat trading not as speculation, but as a structured business that demands professionalism. The market does not reward potential. It rewards execution. The most successful day traders exhibit a specific psychological and behavioral profile, built not overnight, but through deliberate effort, introspection, and market exposure. Emotional discipline under pressure. One of the most critical traits for a day trader is the ability to maintain emotional composure when under pressure. The market is a battlefield where fear and greed are in constant conflict. A trader who panics during drawdowns or becomes euphoric after a string of wins will inevitably sabotage their own progress. Professional traders understand that emotional neutrality is a competitive advantage. They have trained themselves to remain indifferent to the outcome of any single trade. Each setup is treated as one instance in a long sequence of probabilities. A win does not validate them, and a loss does not define them. It is this emotional discipline that allows seasoned traders to execute stop losses without hesitation and to avoid revenge trading after losses. They know that the market is not personal. It does not care about their feelings, their plans, or their needs. In return, they do not ask the market for anything other than opportunity. Their role is to show up and trade their edge, nothing more. Unwavering commitment to risk control. Every professional trader places risk management at the center of their methodology. Unlike the amateur who focuses solely on potential profits, the experienced trader understands that survival is the first priority. To stay in the game, one must preserve capital. This means accepting small, controlled losses as part of doing business. It also means avoiding large drawdowns that can lead to emotional breakdowns and poor decisions. A successful trader never risks more than a small fraction of their capital, often less than 1%, on a single trade. Risk is not something to be avoided, but something to be measured and managed. Proper position sizing, pre-planned stop levels, and disciplined execution of exits are all part of a risk-conscious framework. Successful traders think in terms of risk-to-reward ratios and probabilities, not hopes and guesses. They accept that losses are inevitable. What matters is consistency of process. Over time, the law of large numbers rewards those who control downside risk while letting upside potential work in their favor. Patience and selectivity. Contrary to popular belief, day trading is not about being in constant motion. The most profitable traders are often the most patient ones. They wait for their setups to materialize with precision. They do not chase trades, force entries, or react to noise. They understand that opportunity in the market is not about frequency, it is about quality. Patience allows the trader to avoid overtrading, one of the most common and destructive habits among novices. It also keeps emotions in check because fewer trades mean fewer emotional swings. Selectivity, in turn, ensures that only high-probability setups are acted upon. A disciplined day trader may sit idle for much of the trading session only to strike decisively when conditions align. They are not interested in action for the sake of action. They trade to extract value, and they understand that sometimes the best trade is no trade. Adaptability and openness to feedback. Markets are dynamic. No strategy works forever. A trader who rigidly clings to one method while ignoring changing conditions will eventually suffer. Successful day traders remain adaptive. They observe, test, and iterate. They review their trades daily, study patterns, and analyze what is working and what is not. This feedback loop is essential for growth. It allows them to refine entries, exits, and position sizes. It also reveals psychological tendencies that may need adjustment, such as a tendency to exit early or hold losers too long. Adaptability also extends to market environments. Some days favor trend-following setups. Others require mean reversion tactics. The skilled trader knows how to recognize the type of day unfolding and adjust their approach accordingly. Feedback is welcomed, not resisted. The professional trader knows that ego has no place in this business. Data, not opinion, drives improvement. Intense focus and presence. Day trading demands total focus. A momentary lapse in attention can mean a missed opportunity, or worse, an unnecessary loss. For this reason, successful traders treat each session with the seriousness of a surgeon entering an operating room. They eliminate distractions, prepare meticulously, and enter each day with clear plans and predefined trade ideas. Their screens are organized. Their routines are established. Their minds are sharp. They are not checking social media, flipping through news sites, or reacting impulsively to every tick. They are reading the tape, watching levels, and managing their emotions in real time. Their presence in the moment gives them the edge, because trading is ultimately a game of seconds. Focus also means the ability to stay in the trade once entered. Many traders exit prematurely due to anxiety. The professional understands that execution is not just about getting in, it is also about letting the trade develop as planned, without interference, humility, and respect for the market. The market is the ultimate humbler. The moment a trader believes they have it mastered is the moment they are most vulnerable. Successful traders operate with a quiet confidence, tempered by humility. They do not predict, they prepare. They do not assume, they observe. They are always aware of how little control they have over market outcomes. What they can control is their process. This humility keeps them grounded. It prevents overconfidence after winning streaks and self-doubt after losing ones. It also encourages a constant learning mindset. The best traders are lifelong students of the market. They read, test, and refine, not out of insecurity, but out of respect for the craft. Mechanical execution and detachment from outcome. There is a difference between analyzing the market and executing trades. Many traders can identify solid setups on a chart, but fail to trade them properly due to emotional interference. The solution is mechanical execution. Professionals follow predefined rules. They use checklists, set alerts, and enter stop-loss and profit target levels before the trade begins. Once a trade is active, they minimize interference unless their rules dictate an exit. They are detached from the outcome of any single trade. Whether a trade wins or loses, it is simply one of many in a statistical series. They focus on executing their edge flawlessly, knowing that the profits will follow over time. This detachment is not apathy, it is discipline. It is the result of internalizing that long-term profitability depends on consistent behavior, not short-term results. Cash self-awareness and emotional intelligence. A trader must know the market, but more importantly, they must know themselves. Self-awareness is the ability to recognize personal triggers, strengths, and weaknesses. Emotional intelligence is the ability to manage those internal dynamics in real time. The professional trader is not immune to fear or greed. They simply recognize those emotions when they arise and have developed systems to keep them in check. They know when they are trading well and when they need to step away. They reflect regularly, not just on their trades, but on their mindset. They understand that the markets are a mirror, often revealing more about the trader than about the stock. Self-awareness allows them to trade within their personality. Some thrive on high-speed scalping. Others perform better with slower, more deliberate setups. There is no single best style, only the best fit for the individual. Consistency of routine and process. Success in day trading is built on routines. The best traders treat each session as a ritual. They wake up at the same time, conduct pre-market research, review their journals, and enter the market with clarity. They do not rely on motivation. They rely on structure. Their process becomes muscle memory, allowing them to operate with calmness even in chaotic conditions. This consistency breeds confidence. When the trader knows they have done the work, they can execute with less hesitation. They trust their system because it is rooted in data, reflection, and repetition. The amateur improvises. The professional systematizes. 3. Tools and platforms required for day trading. In the business of day trading, precision is non-negotiable. Unlike long-term investors who can afford to wait out volatility and ride macro trends, day traders need real-time access, split-second execution, and tools designed for tactical advantage. A reliable setup is not a luxury. It is the backbone of any sustainable trading career. From platforms to data feeds to the physical workstation, every piece must be optimized to support quick thinking and fast action. The market rewards preparation. Having the right tools is part of that preparation. They do not guarantee success, but the absence of them can virtually guarantee failure. Professional traders invest in their infrastructure because they know that performance begins with execution, and execution starts with your setup. Hedge, a broker that works for you, not against you. Your broker is your direct gateway to the markets. This relationship must be chosen with care. Professional traders prioritize brokers that offer direct market access, low latency execution, competitive commissions, and stable order routing. There are two primary types of brokers: direct access brokers and retail brokers. Retail brokers, such as the big discount names, often route orders to market makers in exchange for payment for order flow. This may lead to inferior execution, particularly for active traders. In contrast, direct access brokers prioritize speed and transparency. They allow you to route your orders to specific exchanges or ECNs, which can result in better fills and faster execution. For day traders, this distinction matters. When you are managing risk in seconds, delay is not acceptable. Fees and commissions should be considered, but they should not be the sole deciding factor. A broker offering ultra-low commissions but slow executions can cost you more in slippage than you save in fees. Traders focused on intraday precision need a broker that prioritizes execution quality. Some of the most respected direct access brokers in the day trading space include Lightspeed, Cobra Trading, and Interactive Brokers. These brokers cater to active traders, offering powerful routing options, advanced order types, and robust integration with trading platforms. A professional grade trading platform. The trading platform is your cockpit. It is where you analyze, decide, and act. A retail level platform may offer simplicity, but it often lacks the speed, flexibility, and functionality that professionals require. A high quality trading platform should provide real time level 1 and level 2 data, customizable charts, fast order entry capabilities, hotkeys, and seamless integration with your broker. One of the most widely respected platforms for day traders is DAS Trader Pro. It is built for speed and is deeply integrated with direct access brokers. Another popular option is Sterling Trader Pro, also used by prop firms and active traders for its reliability and performance. Platforms like Thinkorswim or TradingView may be acceptable for swing traders or longer timeframes, but most serious intraday traders find them too slow for scalping or fast tape reading. The platform should offer customization options for watch lists, alerts, time and sales windows, and order entry modules. Efficiency is key. You should be able to see your setup, place the order, and manage risk in seconds without switching tabs or navigating slow menus. Hotkeys are another essential feature. These are keyboard shortcuts that allow you to execute predefined actions instantly, such as buying 100 shares at market, placing a stop loss, or closing a position. For day traders, hotkeys save time and reduce the likelihood of execution errors. Market data, speed, depth, and accuracy. Market data is your eyes on the battlefield. It must be fast, accurate, and comprehensive. Real-time data is not optional for a day trader. It is foundational. Delayed data results in poor decisions. Professionals subscribe to premium data feeds to ensure that what they see reflects what is truly happening in the market. There are several tiers of market data. Level 1 data includes the best bid and ask, last trade price, and volume. Level 2 data reveals the order book, multiple layers of bids and asks at different price levels. Time and sales data, also known as the tape, shows each individual trade as it prints. These tools help traders gauge momentum, absorption, and hidden buying or selling pressure. Access to multiple exchanges is also important. Traders operating in U.S. and equities should subscribe to data from exchanges such as NASDAQ, NYSE, ARCA, and BATS. In some platforms, these subscriptions are separate and come at a cost. However, the insights gained often outweigh the expense. Data speed is critical. A delay of even a few seconds can mean entering late, chasing a move, or missing a reversal. Professional traders often use fiber optic connections, dedicated lines, or low latency servers to minimize delay. While this may sound excessive, in the world of active trading, microseconds add up. The physical workstation, built for performance. Just as a Formula One driver needs a high-performance car, a trader needs a workstation that supports peak execution. The setup should be ergonomic, fast, and redundant. A single monitor laptop on a home Wi-Fi network may work for casual browsing, but it is not sufficient for professional trading. At a minimum, a trader should have a desktop with at least 2 high-resolution monitors. One screen can be used for charts and level 2, and the other for watch lists, time and sales, and order entry. Many traders eventually expand to 3 or 4 monitors, allowing for broader market observation and better multitasking. The machine itself should have a strong processor, ample RAM, and a solid-state drive for fast loading and responsiveness. Graphics cards should support multiple displays with high resolution. Backup power sources, such as uninterruptible power supplies, are critical to avoid disaster during blackouts or surges. A wired internet connection is always preferable to wireless for its stability and speed. Redundancy in connectivity, such as a mobile hotspot backup, is a smart precaution. Downtime is not just an inconvenience. It can be financially devastating. The workstation should also support your psychology. Clutter, distractions, and poor lighting lead to fatigue and stress. A clean, quiet, and focused environment helps maintain discipline and mental clarity. Additional tools for decision support. While the core components include broker, platform, data, and hardware, there are other valuable tools that support informed decision-making. These include stock scanners. Real-time scanners, such as Trade Ideas or Benzinga Pro, help identify stocks moving on volume, news, or price action. They are particularly useful for locating intraday momentum plays. News feeds. Fast news can move markets. Professional traders often subscribe to services like Benzinga Pro, Briefing.com, or even Bloomberg for early access to headlines. Economic calendar. Knowing when key events, such as Federal Reserve announcements, CPI releases, or job reports, are scheduled is vital. These events cause volatility and require special attention or avoidance. Charting software. While most trading platforms include basic charting, some traders prefer external tools like TradingView for their advanced indicators, drawing tools, and sharing capabilities. Trade journal. Logging trades is essential for growth. Journals such as TraderSync, EdgeWonk, or even custom spreadsheets allow you to analyze patterns, mistakes, and edge performance over time. Cost considerations and long-term ROI. A professional trading setup involves upfront investment. Between market data fees, broker commissions, software subscriptions, and equipment, costs can add up quickly. However, these are not expenses. They are operational inputs for a performance-based business. Just as a surgeon invests in the best tools or a pilot trains on advanced simulators, a day trader must commit to the infrastructure that supports peak performance. Cutting corners on tools often results in higher long-term losses. For traders starting with limited capital, it is advisable to simulate trades first using demo accounts. Many platforms offer virtual trading environments that mirror real conditions. This allows you to practice execution, build habits, and test strategies before risking real capital. Eventually, the investment in tools pays for itself, not just in better trades, but in reduced slippage, faster exits, clearer analysis, and improved psychology. In trading, clarity and confidence are worth far more than cost savings. 4. Chart analysis and technical indicators. In the realm of day trading, speed and clarity are essential. There is no time to decipher dense reports or interpret complex economic theories. Price, volume, and structure reflected on a chart are the language of the short-term trader. While investors may pore over financial statements and long-term trends, the day trader lives in the present moment. Their edge comes not from knowing what a company is worth, but from knowing how a stock is behaving right now. Technical analysis is the process of interpreting market activity through price charts, volume patterns, and indicators. It is not about prediction, it is about probability. Charts are visual representations of the collective psychology of buyers and sellers. They reveal the footprints of large players, moments of imbalance, and the rhythm of supply and demand. A professional day trader does not need a chart filled with noise. They seek simplicity. A clean chart provides clarity. Clarity leads to better decisions. Better decisions produce better results. The role of price action. At the core of all technical analysis lies price action. Price action refers to the movement of a stock's price over time, as visualized through candlesticks, trend lines, and chart structures. Candlestick charts are favored by most professionals because they convey more information than simple line charts or bars. Each candlestick shows the open, high, low, and close within a given time frame, often 1 minute, 5 minutes, or 15 minutes in the context of day trading. Patterns such as engulfing candles, doji, hammers, and shooting stars provide insight into the strength or weakness of a move. More important than any single candle is the context it appears in. A bullish candle in isolation means little, but a bullish engulfing candle at a clear support level accompanied by rising volume may suggest accumulation and a potential reversal. Professional traders use price action to identify key levels of support and resistance. These are prices where the market has historically reacted, either rejecting or accepting them. Breakouts above resistance or breakdowns below support are often signals for continuation, while failure to break through these levels may signal reversal or consolidation. Volume, the fuel behind the move. Volume is the confirmation of price. Without volume, price movement lacks conviction. A breakout on low volume is suspect. A breakout on high volume is meaningful. Volume reveals participation. How many traders and institutions are engaged in a move? Day traders pay close attention to volume spikes, which often precede momentum. An unusual increase in volume may be the result of news, earnings, or institutional interest. These moments often produce the volatility that short-term traders seek. Volume also helps distinguish between strong and weak trends. A trend accompanied by consistent volume suggests sustainability. A trend with fading volume may be nearing exhaustion. Many platforms offer volume overlays and volume profile tools, which show where the most trading has occurred across price levels. These high volume nodes act as magnets and often become areas of congestion or reversal. HASP, moving averages, smoothing chaos. Moving averages are among the most widely used technical indicators, not because they predict, but because they clarify. A moving average takes the average closing price over a certain number of periods, smoothing out noise and helping traders identify direction. For intraday trading, exponential moving averages, EMAs, are preferred over simple moving averages, SMAs, because they react more quickly to price changes. Common settings include the 9-period EMA and 20-period EMA. These lines can serve as dynamic support and resistance or trend confirmation tools. When price is consistently above the 9 EMA and the slope is upward, the short-term trend is bullish. When price is below and the slope is negative, the trend is bearish. Crossovers between short and long EMAs may suggest potential reversals, but professionals use them in context, not as isolated signals. It is essential to remember that moving averages are lagging indicators. They reflect what has happened, not what will happen. Their power lies in supporting the story that price action and volume are already telling. VWAP, the institutional benchmark. The volume-weighted average price, or VWAP, is a critical tool for day traders. It calculates the average price a stock has traded at throughout the day, weighted by volume. VWAP acts as an intraday benchmark, used heavily by institutions to measure execution quality. In practice, VWAP serves as both a magnet and a barrier. Price may revert to VWAP after extended runs or bounce off VWAP in trending conditions. Many traders use VWAP to define bias. When price is above VWAP, buyers are in control. When price is below, sellers dominate. VWAP is particularly useful during consolidation or range-bound trading. Breakouts from VWAP with increasing volume often signal the start of directional movement. However, during highly volatile conditions, price may whip around VWAP unpredictably, so context remains key. Level 2 and time and sales. Beyond charts, many day traders use raw market data known as Level 2 and time and sales. Level 2 displays the order book, showing the bid and ask prices across multiple price levels, along with order size. This reveals the depth of the market and may provide clues about hidden buying or selling pressure. Time and sales, also known as the tape, displays each executed trade in real time, including price, size, and exchange. Reading the tape is a skill that requires practice. Skilled tape readers can detect momentum shifts, order absorption, and aggressive buying or selling. While not technically part of chart analysis, these tools provide a deeper layer of market understanding. They are particularly useful for scalpers or those entering at precise inflection points. Technical indicators. Less is more. While platforms offer hundreds of indicators, professional traders tend to use only a few and use them well. Indicators should serve as confirmation, not primary decision makers. They are tools, not crutches. Some commonly used indicators include Relative Strength Index, RSI, measures momentum and potential overbought or oversold conditions. An RSI above 70 suggests a security may be overextended to the upside, while below 30 may indicate oversold conditions. MACD, Moving Average Convergence Divergence, tracks the relationship between two EMAs to identify trend strength and potential reversals. The MACD line crossing above or below its signal line can suggest momentum shifts. Bollinger Bands use standard deviations from a moving average to measure volatility. When price touches the upper or lower bands, it may suggest temporary extremes, but this is not a standalone signal. The key is to avoid clutter. A chart loaded with indicators creates confusion and delays decision-making. Professional traders typically use only 2 or 3 complementary indicators, with the majority of decisions still anchored in raw price action and volume. Multi-time frame alignment. One of the most effective but underutilized strategies in chart analysis is multi-time frame alignment. This means analyzing the same stock across different time intervals, such as the daily, 15-minute, and 5-minute charts, to find confluence. A breakout on the 5-minute chart carries more weight if it aligns with a key resistance level on the daily. Likewise, a reversal pattern on the 1-minute chart is more trustworthy if the larger trend on the hourly is also reversing. Multi-time frame analysis provides perspective. It helps traders avoid false signals and recognize when an intraday setup is backed by broader structural significance. Structure and psychology. At its core, technical analysis is the study of human behavior. Charts reflect emotion, fear, greed, hope, panic. Patterns such as double tops, flags, wedges, and breakouts are visual expressions of collective psychology. A double top forms because traders recognize resistance and begin to take profits, while new buyers hesitate. A breakout occurs when fear of missing out overtakes fear of loss. Consolidation is indecision. Reversals are capitulations. Professional traders study chart structure not just for the sake of patterns, but to understand what market participants are doing and feeling. This insight allows them to enter ahead of the crowd, not with prediction, but with probabilistic reasoning. 5 popular day trading strategies. In day trading, strategy is everything. Without a clearly defined method of entry and exit, a trader is simply gambling. The best day traders do not rely on gut feelings or instincts. They follow proven strategies with strict discipline, understanding that consistency over time is what separates professionals from amateurs. A good strategy provides structure, repeatability, and confidence. It must be simple enough to execute in real time, yet robust enough to adapt to changing market conditions. Below are some of the most popular and battle-tested strategies used by professional day traders. Opening range breakout, ORB. The opening range breakout strategy is built around the volatility that occurs in the first 15 to 30 minutes after the market opens. During this time, the market establishes an early high and low. This is called the opening range. Traders watch how price behaves around these levels. If the stock breaks above the opening high on strong volume, it signals bullish momentum. A break below the opening low suggests bearish strength. The idea is to ride the momentum once the direction becomes clear. Key elements of this strategy include selecting stocks with high pre-market volume and catalysts such as earnings or news, waiting for the opening range to form, usually the first 5 to 15 minutes, placing entries once price breaks out of that range, confirmed by volume, managing risk with tight stop-loss orders just inside the range. ORB works best on stocks with high relative volume and clean setups. It capitalizes on institutional flows and early trader sentiment. Momentum trading. Momentum trading is one of the core principles in day trading. This strategy involves identifying stocks that are moving rapidly in one direction with increasing volume and riding the trend for a quick gain. These moves are often driven by breaking news or earnings reports, analyst upgrades or downgrades, large institutional interest, sector-wide movement. Traders enter as the move begins to build and exit before the momentum fades. The key to momentum trading is speed, decisiveness, and strong risk control. Components of momentum trading include using scanners to find stocks with high volume and price surges, entering at pullbacks within a strong trend or at breakout levels, monitoring the volume-weighted average price, VIP, and moving averages as dynamic support and resistance, avoiding overextended entries and chasing parabolic moves. Momentum trading requires precision and a fast mindset. While the gains can be substantial, so can the losses if one hesitates or fails to exit quickly. Reversal strategy. Markets move in waves. After a strong move in one direction, stocks often pull back or reverse due to profit-taking or exhaustion. Reversal strategies aim to capture these turning points, often at key support or resistance levels. There are 2 types of reversals. Trend reversal occurs after a prolonged trend has lost steam. Intraday pullback reversal, a shorter-term reaction within a broader trend. Traders look for double tops or bottoms, candlestick reversal patterns like doji, hammer, or engulfing bars, divergence between price and indicators like RSI or MACD, volume spikes signaling climax buying or selling. Reversal trades offer great risk-reward ratios because entries are often near extremes. However, timing is crucial. Entering too early can lead to losses. Waiting for confirmation increases the probability of success. Pullback strategy. Not all strong stocks move in straight lines. After a breakout, prices often pull back to retest prior levels before continuing. The pullback strategy involves entering after the initial surge, during the brief moment when price retraces before resuming its trend. Ideal pullbacks occur to a rising EMA, such as the 9 or 20 EMA, at previous breakout levels acting as new support or resistance. On decreasing volume, signaling the pullback is temporary. Once price stabilizes and volume starts to return, traders enter in the direction of the original trend. Stop losses are placed below the low of the pullback. Pullback trading rewards patience and precision. It allows traders to enter high momentum stocks at better prices, reducing risk and maximizing profit potential. Hash high of day and low of day break. Many intraday moves are driven by the breaking of key levels, such as the high of day, HOD, or low of day, LOD. These levels represent the strongest points of buying or selling up to that moment and are closely watched by institutional traders and algorithms. The strategy involves monitoring stocks that approach their HOD or LOD with increasing volume, confirming with level 2 and tape reading for order flow support, entering as the breakout begins, with stop losses just below for long trades or above for short trades, the breakout level, managing trades tightly due to potential false breakouts or reversals. HOD-ELA breaks are particularly effective in stocks with news catalysts, strong relative volume, or sector momentum. VWAP bounce and reclaim. The volume-weighted average price, VWAP, is a critical reference point for institutions and day traders alike. It acts as a balance point for intraday movement. There are two common strategies using VWAP. VWAP bounce. If a stock is trending above VWAP and pulls back to it on low volume, it often bounces off the VWAP and continues upward. VWAP reclaim. If a stock drops below VWAP and then reclaims it on strong volume, it can signal a bullish shift in sentiment. Traders use VWAP in combination with candlestick confirmation and relative strength to time their entries. Stops are placed just beyond VWAP to manage risk. This strategy is especially powerful in the middle part of the trading day, where momentum tends to slow and mean reversion plays become more reliable. Scalping strategy. Scalping involves making multiple quick trades to capture small price movements. This strategy is built for speed and is often executed using level 2, the tape, and ultra-fast execution platforms. Scalpers look for tight spreads and high liquidity, clear short-term support and resistance, price action near key intraday levels, momentary inefficiencies, or price dislocations. Each trade may target gains of only 10 to 20 cents, but a skilled scalper can take dozens of trades in a session. Scalping requires exceptional focus, discipline, and fast decision-making. Because the margin for error is small, many traders combine scalping with other strategies like VWAP plays or HOD-ELA breaks for better context. Breakout and fake-out traps. Not all breakouts succeed. Many fail and reverse, trapping traders who entered too late or without confirmation. Some advanced traders specialize in trapping strategies, waiting for the breakout and then taking the opposite side once it fails. This strategy includes identifying extended moves near psychological levels, watching for failed breakouts or breakdowns on low volume, reversing the position once the false move is confirmed, using tight stops and predefined targets. Trapping trades are risky but can offer excellent asymmetric setups. They reward deep understanding of price behavior, tape reading, and patience. Final thoughts on strategy. A strategy is only as good as its execution. Traders must backtest, forward test, and track every trade in a journal. More important than the specific strategy is the consistency in applying it. No single strategy works all the time. The best traders adapt, switching between momentum, reversal, or pullback setups depending on market conditions. Some days favor trend continuation. Others reward mean reversion. Flexibility, without abandoning discipline, is key. A professional day trader does not chase trades. They wait for their setup. When it appears, they act without hesitation. When it does not, they stay in cash. Strategy brings freedom. It removes emotion and creates edge. And in the business of day trading, edge is survival. 6. The importance of capital management and risk control. In the world of day trading, survival precedes success. A trader might possess sharp technical skills, a reliable strategy, and even emotional discipline. But without effective capital management and risk control, those strengths mean very little. As Andrew Aziz emphasizes, capital is a trader's inventory. Lose it, and the business is over. Managing money in trading is not about maximizing profits every single day. It is about staying in the game long enough for your edge to play out. Professional traders understand that losing days are inevitable. What matters is ensuring that no single trade or even a bad day can destroy your account. Trading is a business, not a hobby. A key principle in professional trading is treating it like a business. Just like a retail store manages inventory or a restaurant controls costs, a trader must manage risk. That starts with capital preservation. No serious business owner would invest all of their capital into a single day's operations or one product line. Likewise, no serious trader should risk their entire account on a single position. Successful traders allocate risk with the same care that a business allocates resources. Every trade is a calculated investment, not a gamble. The goal is not to avoid risk entirely, but to ensure that the risks taken are intelligent, manageable, and statistically favorable. The 2% rule. One of the most important rules in day trading is to never risk more than 2% of your account on any single trade. That means that if your account holds $10,000, your maximum acceptable loss per trade should be no more than $200. This rule exists to protect traders from catastrophic loss. Even after 5 consecutive losing trades, a trader who follows the 2% rule will only be down by roughly 10%, a manageable drawdown from which they can recover. The math becomes clear over time. Lose 2% per trade for 5 trades equals 10% drawdown. Lose 20% per trade for 5 trades equals account nearly wiped out. The difference between a professional and an amateur often comes down to risk sizing. Professionals aim to last. Amateurs aim to win big. And in trading, trying to win big often leads to losing everything. Understanding drawdowns. Drawdowns are periods when your trading equity falls from a peak to a trough. All traders, even the best ones, experience drawdowns. The key difference is how those drawdowns are managed. A well-capitalized trader who risks small percentages per trade can withstand a string of losses and keep trading with a clear head. A trader who over-leverages during a losing streak often panics, overtrades, or blows up the account. Managing drawdowns requires keeping trade size proportional to account size, limiting the number of trades per day, setting daily loss limits, such as stopping after losing 3 trades or hitting 5% of total capital, reviewing performance before re-entering the market after a losing streak. Drawdowns should not just be endured, they must be studied. They often reveal weaknesses in strategy, discipline, or emotional control. Position sizing and expectancy. Position sizing is the foundation of capital management. Before every trade, a professional asks, what is the risk per share or per contract? How many shares can I take while staying within my 2% rule? What is the potential reward compared to the risk? Let's break this down. Suppose a setup has a 50-cent stop loss. With a $200 risk budget, the trader can take 400 shares, 200 divided by 0.5. If the target is $1.5 above the entry, the trade offers a 3-to-1 reward to risk ratio. That is excellent expectancy. High win rate setups with low reward to risk can still work, but the math must be solid. Traders should journal their performance and calculate expectancy, the average amount made or lost per trade over time. The formula is, open quote, expectancy equals win rate average win, loss rate average loss, close quote. A positive expectancy, applied with consistent position sizing, leads to profitability. A strategy with negative expectancy, even with strict discipline, results in losses. Stop loss, your best defense. One of the most misused and misunderstood tools in trading is the stop loss. Novice traders often move or ignore stop-loss orders when price nears them, hoping the market will reverse. Professionals do the opposite. They respect their stops. A stop-loss is not a suggestion. It is a pre-planned exit point, placed to protect capital when a trade idea proves wrong. A trader who disrespects stop-loss levels is not managing risk, they are gambling. Well-placed stops are located beyond obvious noise or minor retracements, reflect the technical structure of the trade, such as just beyond support or resistance, are paired with appropriate position size so that the dollar risk stays within limits. Stops are not about being right, they are about not being ruined. Taking a small loss is the price of staying in business. Take profit levels and partial exits. Just as a stop loss controls your downside, take profit targets manage your upside. Knowing when to exit is as important as knowing when to enter. Some traders prefer fixed profit targets, such as 2 to 1 or 3 to 1 reward to risk. Others use dynamic targets based on price action, VWAP, or moving averages. One popular method is the partial exit strategy, scaling out of the position in chunks. Sell half at 2 to 1 profit. Move stop to break even. Let the rest ride if the trend continues. This approach locks in gains and reduces emotional pressure. It also removes the all or nothing mindset, allowing for smoother equity curves, daily and weekly risk limits. Risk is not only about individual trades, it is also about controlling the overall damage in a day or a week. Professional traders often set daily loss limits to protect against emotional spirals and bad streaks. Example limits: maximum of 3 losing trades per day, maximum of 5% account drawdown per day. Weekly review of performance to adjust strategy or stop trading temporarily. By capping daily risk, traders protect their confidence, their account, and their ability to think clearly. One bad trade is recoverable. One bad day is manageable. One undisciplined week can be devastating. Emotional impact of poor risk control. Poor capital management leads not just to financial loss, but to psychological damage. When traders lose more than they can handle, fear sets in. They hesitate, overthink, or revenge trade. Confidence erodes. The clarity that good trading requires disappears. Risk control, by contrast, builds confidence. When you know that no trade can ruin you, you can execute with calmness and professionalism. You trade the setup, not your emotions. Capital management is not about avoiding loss. It is about containing it. Losses are the cost of doing business, but they must be small, planned, and acceptable. Professional mindset toward risk. The difference between a retail mindset and a professional one is clear. Amateurs ask, how much can I make? Professionals ask, how much can I lose? Professionals treat risk as a measurable, controllable variable. They do not fear it, but they deeply respect it. Every trade is entered with a plan, including the exact dollar risk, exit points, and worst-case scenarios. Risk control is not optional. It is not something to add later. It is the foundation of a sustainable trading career. Without it, even the best strategies and sharpest minds will eventually fail. 7. Trading as a business. To succeed in day trading, one must approach it not as a hobby, a thrill, or a quick path to wealth, but as a serious business venture. This is perhaps the most underappreciated yet most transformative mindset shift that a trader can make. The casual approach leads to casual outcomes. The business approach builds foundations for consistent performance, professional behavior, and long-term success. Just as a business owner meticulously manages overhead, capital, inventory, and customer service, a trader must manage risk, capital allocation, market strategy, and emotional discipline. Treat your capital like inventory. Imagine running a store that sells high-end electronics. You would never risk all your inventory on an unproven product or allow your shelves to sit empty. You would carefully study trends, track performance, and adjust pricing based on supply and demand. Your trading capital is your inventory. Every dollar is a unit of business capacity. Every trade is a use of your limited inventory. Recklessly risking large portions of your account without a process is the equivalent of gambling your entire store's inventory on a single untested item. Professional traders aim to grow their inventory slowly and methodically by making consistent, controlled trades that align with their strategy and plan. Have a trading plan and execute it with discipline. No business operates successfully without a plan. Whether it is a tech startup, a restaurant, or a manufacturing company, a structured blueprint guides daily operations and long-term strategy. Your trading plan is your operations manual. It should clearly outline your entry criteria for each setup, your exit rules, both for profits and for losses, your risk management parameters, your watch list preparation routine, your pre-market and post-market analysis workflow. A plan is useless without execution. That is where discipline comes in. Business owners cannot afford to operate based on mood or impulse. Likewise, traders must commit to executing their plan without deviation. Consistency in execution is what turns randomness into statistical edge. Track performance like a business tracks revenue. Any successful business knows its numbers. It knows how much revenue it generates daily, weekly, and monthly. It monitors expenses, margins, customer acquisition cost, and return on investment. Similarly, traders must track every trade. This includes entry and exit points, size and risk, win or loss amount, setup type, mistakes made or rules followed, screenshots of the chart. This data is not just for record keeping, it is for analysis. Over time, it reveals what strategies are working, what time of day is most profitable, and where mistakes are costing money. Without tracking and review, improvement is impossible. Hack understand fixed and variable costs. Even though trading appears to have no inventory or office space, it still comes with costs, both fixed and variable. Fixed costs include market data subscriptions, broker platform fees, trading software licenses, education and mentorship. Variable costs include commissions, slippage, internet reliability, emotional capital spent on stress. If you do not treat these like legitimate business expenses, they will eat away at your profits. High-frequency trading with excessive commissions or poor fills can destroy edge. In the long run, cutting costs and optimizing execution improves your bottom line. Build and maintain a trading journal. A business keeps books, so should a trader. A trading journal is more than a log, it is a diagnostic tool. It shows you patterns in behavior, setup quality, and emotional reactions. It lets you see clearly whether losses were the result of the market or of your own deviation from process. Key components of a trading journal: trade date and ticker, setup name, entry and exit rationale, risk to reward, size, screenshots, post-trade reflection. Was the trade according to plan? How did you feel? Over time, your journal becomes your greatest mentor. It does not lie. It reflects who you truly are as a trader and gives you the data to make improvements, just like a business uses financial statements to guide decisions. Allocate time like a professional. Business owners have work hours. They clock in, do focused work, and clock out. They do not binge watch markets with no structure or chase random opportunities. Successful traders treat time like capital, precious and limited. Professional traders create a structured schedule. Pre-market, scanning, reviewing setups, preparing watch lists. Market open, trading core strategies with focus. Midday, break or light analysis. Post-market, journaling, analysis, preparation. They also take days off intentionally, understand when the market conditions are not favorable for their edge, and treat rest as part of performance optimization. You do not need to trade 8 hours a day. You need to trade 1 or 2 hours with sharp, professional execution. Manage emotions like managing team morale. In business, morale affects productivity. A good leader manages the emotional state of the team to maintain performance. In trading, you are both the boss and the employee. Emotional intelligence is a critical part of your role. Good emotional management in trading includes knowing when to walk away after a losing streak, avoiding revenge trades, celebrating process, not just profits, being honest in post-trade reviews, maintaining confidence without becoming reckless. Professional traders develop mental routines just as athletes prepare for games. They reflect, visualize, practice self-awareness, and maintain resilience. Scale responsibly and reinvest intelligently. Once a business is profitable, it scales by reinvesting profits into growth, new tools, new talent, or expanded capacity. In trading, scaling comes from increasing position size in proportion to account size and performance. Premature scaling is one of the top reasons traders blow up. A trader who moves from risking $50 to risking $500 overnight just because of a few wins is likely to suffer psychologically and financially. The professional approach: only increase size after consistent profitability. Use trailing performance metrics to determine readiness. Reinvest profits into better tools, faster execution, or continued education. Growth must be sustainable. Your mindset, strategy, and risk control must grow with your account. Prepare for taxes and regulations. A business pays taxes, so does a trader. In many countries, day trading has specific tax rules, including capital gains rates, reporting obligations, and eligible deductions. Serious traders keep detailed records of all trades and transactions. Consult with tax professionals. Set aside tax reserves in advance. Understand the rules that apply to their country or region. Failing to prepare for taxes can turn a winning year into a nightmare. Professionalism requires legal and financial compliance. Think in quarters, not days. Businesses think in quarters and years. They measure performance over time, accept temporary setbacks, and aim for consistent growth. Amateur traders obsess over daily profits and losses. Professionals zoom out. A single red day means nothing in the context of a quarter. What matters is maintaining process, sticking to edge, and compounding over time. Develop a quarterly mindset. Set goals in terms of number of quality trades, adherence to risk limits, growth in equity curve, reduction in mistakes. Just like a company's quarterly report reveals its true health, your trading journal and equity curve over weeks and months tell the real story. Conclusion: be the CEO of your trading desk. If you want to succeed as a day trader, start thinking like the chief executive officer of a company. Your account is your business. You are responsible for its operations, its risk, its growth, and its sustainability. Most traders fail because they treat trading like a video game, a lottery ticket, or a side hustle. Professionals treat it like a high-performance business where discipline, structure, and long-term thinking are non-negotiable. Become the CEO of your trading. Set your plan, measure your results, refine your processes, make tough decisions, take responsibility, and above all, protect your capital like a business protects its lifeblood. Bạn có muốn tôi viết tiếp phần 8? 8. Trading in a simulated environment. Before risking real money, every trader must prove themselves in a risk-free environment. Simulated trading, also known as paper trading or demo trading, is not a game. It is your training ground. It is where you build skills, test strategies, refine your edge, and, most importantly, develop the mindset of a professional without the emotional and financial consequences of real losses. Just like a pilot trains in a flight simulator before flying a real jet, a trader must first master the controls of their strategy, platform, and psychology in a virtual environment. Sim trading is not optional. It is essential. Many beginner traders underestimate the value of simulation. They believe they can learn faster by jumping into live markets. But real markets are unforgiving. Without preparation, mistakes are costly, both emotionally and financially. Sim trading provides the opportunity to learn the trading platform and order execution tools, practice scanning and building watch lists, test entry and exit strategies, develop discipline and routine, track performance without financial risk. A trader who skips simulation is like a soldier entering battle without training. It is not bravery, it is recklessness. Build muscle memory for execution. Markets move fast. At the open, volatility is high and opportunities are fleeting. In such conditions, your ability to execute must be automatic. Sim trading helps you build that speed and precision. Through repetition, you develop fast order entry without errors, immediate stop-loss placement, recognition of chart patterns in real time, fluid use of hotkeys and platform tools. Think of it like sports. Athletes do not learn during the game. They train before it. The same is true for trading. Sim trading is your practice arena, where you build habits and refine reactions. Develop emotional awareness without financial pressure. Although simulated trading lacks real money consequences, it still reveals your emotional tendencies. Do you get greedy when a trade moves in your favor? Do you cut winners too soon out of fear? Do you revenge trade after a loss? These patterns appear even in simulation if you approach it seriously. By journaling emotional reactions during sim trading, you begin to build emotional intelligence and awareness. This emotional groundwork is critical. When you transition to live trading, your emotional triggers will amplify. Simulation prepares you to recognize and manage them in advance. Validate your strategy with historical context. Simulation allows you to test strategies across different market conditions, volatile days, trending days, chop zones, and news events. This helps you answer key questions. Does your strategy work in fast-moving markets? Is it effective in low-volume conditions? How does it perform during earnings season? Professional traders do not rely on hope. They rely on data. Sim trading lets you gather a statistically meaningful sample size before risking capital. You prove that your edge is real, not imagined. Most traders who fail never tested their strategy. They operated on assumptions. Simulation replaces assumption with evidence. Treat sim trading as real trading. The benefit you get from sim trading depends on how seriously you take it. If you treat it like a video game, you gain nothing. If you treat it like real trading, With rules, limits, and journaling, you develop true skill. Approach sim trading with these principles. Use realistic position sizing. Follow your actual risk parameters. Stop trading for the day after a set number of losses. Journal each trade, including screenshots and emotional notes. Track performance metrics like win rate, average risk to reward, and drawdown. When treated professionally, sim trading is not wasted time. It accelerates your development. Transitioning from sim to live trading. The biggest mistake traders make is staying in simulation for too long or switching to live too soon. The transition should be made with clarity and benchmarks. Ask yourself, have I followed my trading plan for at least 30 days without deviation? Is my simulated equity curve stable or growing? Am I emotionally composed during simulated losses? Have I achieved consistent profitability with realistic size? If the answer is yes to all, begin transitioning with real money in small size. The goal is not to make money. It is to learn to manage real emotions while preserving capital. Start with 1 share, then 5, then 10. Increase only after consistency. There is no rush. Real trading is a marathon, not a sprint. Use simulation for continuous improvement. Even professional traders return to simulation to test new setups, refine entries, rebuild confidence after a drawdown, practice during low volatility days, adjust to new market regimes. Simulation is not just for beginners. It is a lifelong tool. Businesses run simulations before launching new products. Athletes practice before competitions. Traders should use simulation to continuously sharpen their edge. If your equity curve stalls, your confidence drops, or your strategy needs adjustment, go back to simulation. It is not a step backward. It is a strategic reset. Combine sim data with backtesting. Simulation shows you how a strategy works in real time. Backtesting shows how it would have performed over historical data. Both are necessary. Together, they help answer: does the strategy have positive expectancy? Are results consistent across different market phases? What is the maximum drawdown? What is the average time in trade? Use backtesting to define strategy rules and edge. Use simulation to practice executing those rules under live market dynamics. It is the bridge between theory and action. Emulate professional trading conditions. To make your simulation effective, replicate live conditions as closely as possible. Use the same software and platform you plan to trade with. Trade during the same hours as the real market open. Avoid speeding through candles or jumping timeframes. Include commissions and slippage in calculations. Track risk as if real money were at stake. By mirroring reality, you train your body and mind to operate professionally. Build confidence without ego. Confidence in trading comes from preparation, not luck. Simulation helps you build that preparation in a low-risk environment. Every winning trade in sim builds belief in your process. Every losing trade, when handled properly, teaches resilience and discipline. Confidence grows from seeing the strategy work over time, not from random success. But be cautious. Confidence must be based on process, not ego. Ego says, I will win no matter what. Process says, I will follow my edge and manage risk. Sim trading reinforces the latter. Conclusion: simulation is your professional foundation. No trader becomes elite without training. Simulated trading is that training. It is your boot camp. It is your proving ground. It is your lab for experimentation, your gym for execution, and your safe space for emotional development. Traders who rush into live markets without simulation are like surgeons operating without practice, or pilots flying without logging simulator hours. The result is predictable: failure. But traders who treat simulation with respect, structure, and intention are the ones who develop the skills and confidence to trade for a living. Simulation does not make you money, but it makes you the kind of trader who can. 9. Habits of successful traders. Success in day trading is not the result of a single breakthrough, secret strategy, or lucky trade. It is the product of discipline, structure, and the repetition of high-quality behaviors every single day. Just as elite athletes and top executives rely on habits to sustain peak performance, so do professional traders. These habits are not glamorous, but they are effective. They are grounded in consistency, process, and mindset. Below are the foundational habits that distinguish profitable traders from amateurs who never reach sustainability. They start each day with a pre-market routine. Successful traders do not wake up and jump into the market unprepared. They follow a consistent pre market routine that primes their mind, aligns their strategy, and sets the tone for execution. This routine often includes reviewing the economic calendar for scheduled events, scanning gappers and stocks in play, reading market news and earnings reports, reviewing watch lists and trade ideas, visualizing execution scenarios, practicing breathwork or mindfulness to enter a calm, focused state. The goal is to enter the open with clarity, not chaos. Successful traders do not react, they prepare. They journal every trade. Journaling is not optional. It is the cornerstone of self-awareness and improvement. Winning traders treat every trade as a data point in a much larger picture. After each session, they record entry and exit points, size and direction, reason for entry, setup, trade management decisions, outcome, emotional state before, during, and after the trade, lessons learned. Over time, this journal becomes a roadmap. It reveals patterns in behavior, exposes recurring mistakes, and highlights areas for refinement. Traders who do not journal remain blind to their habits. Those who do gain insight and control. They control risk with military precision. One of the most consistent traits among profitable traders is ruthless risk management. They never risk more than they can afford to lose. They use stop losses religiously. They size their positions according to volatility and account size. They accept small losses as part of the business. Successful traders never let ego override discipline. They do not hope trades come back. They do not average down on losers. They do not let a single trade destroy their week. They know survival is everything. Their motto: protect capital first, profit second. They review performance weekly and monthly. Daily journaling provides micro-level data. Weekly and monthly reviews provide the macro view. At the end of each week or month, high-performing traders study their metrics: win rate, average risk to reward, maximum drawdown, average time in trade, number of trades per day, profit factor, net gain or loss. These metrics help them adjust strategies, refine setups, and track growth. They treat trading like a business, and every business requires performance audits. Hedge. They specialize instead of chasing everything. Amateur traders jump from strategy to strategy, hoping to find the holy grail. Successful traders specialize. They master one or two setups and execute them with surgical precision. They do not try to trade every stock or every strategy. They know their edge. Perhaps it is momentum breakouts, or VWAP reversals, or opening range breakdowns. They study that edge deeply. They know the best time of day, the right market conditions, and the exact risk parameters. By focusing, they reduce noise and increase quality. They trade less, not more. Contrary to popular belief, successful traders do not overtrade. They understand that capital is limited and emotional energy is finite. They wait for high probability setups and skip the rest. They do not chase. They do not force trades to meet a quota. They know that sitting on their hands is a position. Patience is their power. Often, their best days involve only one or two trades, executed with full attention and discipline. They practice emotional regulation. Trading is emotional warfare. Fear, greed, frustration, excitement, they all arise during market hours. Successful traders do not eliminate emotions. They learn to observe, understand, and regulate them. Many use techniques such as meditation or breath work, affirmations and mindset priming, step-away rules after losses, controlled environments, quiet, minimal distractions, trading checklists to remain grounded. They do not seek excitement from trading. They seek consistency and calm. Trading is a job, not a thrill ride. They seek feedback and mentorship. Top traders do not operate in isolation. They understand the value of community, accountability, and mentorship. They participate in trading rooms, mastermind groups, or one-on-one coaching. They welcome feedback, even when it challenges their ego. Mentors help them see blind spots. Fellow traders provide alternative perspectives. Dialogue sharpens their thinking. They do not let pride block progress. They stay physically and mentally sharp. The mind and body are not separate. Successful traders take care of both. They sleep well. They eat clean. They exercise. They protect their energy. Why? Because fatigue, stress, or brain fog directly impacts decision-making. They treat themselves like athletes preparing for peak performance. They know that a tired trader is a reckless trader. They adapt without abandoning discipline. Markets evolve. Strategies that worked last year may underperform today. Successful traders do not cling to the past. They remain agile, open to new setups, and aware of shifts in market structure. However, adaptation never means abandoning discipline. They change their tools, but not their rules. They innovate without compromising on risk or emotional control. They accept uncertainty and avoid predictions. Unlike amateurs who try to call the top or predict the bottom, professional traders embrace uncertainty. They trade probabilities, not predictions. They execute based on setups, not opinions. They never marry a stock or force a narrative. They understand that losses are part of the game. They do not aim to be right, they aim to be profitable. That distinction is everything. They separate process from outcome. Not every good trade makes money, and not every bad trade loses money. Winning traders know the difference. They evaluate trades based on execution, not results. If a trade followed the plan, managed risk, and fit the setup criteria, but resulted in a loss, they consider it a success. If a trade broke rules but made money, it is flagged as a danger sign. This mindset ensures long-term sustainability. It trains the trader to honor the process, not chase random gains. They maintain humility and curiosity. Finally, successful traders remain humble. They know the market is bigger, faster, and more unpredictable than any individual. They stay curious, always learning, always refining. They read, they backtest, they study tape, they attend webinars. They never say, "I've figured it all out," because they know those who stop learning stop winning. Conclusion: success is built, not discovered. Habits are the infrastructure of professional trading. They are not glamorous. They are not exciting, but they are powerful. When repeated daily, they create discipline, clarity, and performance. Most importantly, they allow you to navigate the chaos of the market with consistency. If you want to trade for a living, build the habits of those who already do. Process over prediction, discipline over excitement, consistency over intensity. Your results will follow your routine. Build the right one and protect it like your trading capital. 10. Trading psychology. Trading is not a battle against the market. It is a battle within yourself. Many aspiring traders study charts, indicators, and strategies, only to discover that knowledge alone does not generate consistent profits. The missing link is not information. It is psychology. Trading psychology is the mental and emotional framework that governs decision-making under pressure. It is the difference between following a plan and breaking it, between letting a loss run or cutting it, between staying objective or becoming reactive. Understanding and mastering your own mind is the final edge and the most sustainable one. The emotional landscape of trading. Every trade triggers emotions. Even if you think you are logical and calm, markets will test your emotional resilience. These are the most common psychological states that traders face. Fear, the fear of missing out, the fear of being wrong, the fear of losing. Fear often leads to hesitation, premature exits, or avoidance of valid setups. Greed, the desire to maximize every opportunity, can lead to overtrading, holding past profit targets, or ignoring risk controls. Hope, hoping a losing trade will turn around, often leads to disaster. Hope is not a strategy, it is a trap. Frustration, after a string of losses or missed entries, frustration clouds judgment and fuels revenge trading. Euphoria, ironically, winning can be just as dangerous as losing. Overconfidence after a big win often results in reckless behavior. You cannot eliminate emotions, but you can train yourself to respond to them with awareness and discipline. Emotional self-awareness. The first step in mastering trading psychology is emotional self-awareness. This means recognizing your triggers, tracking your emotional patterns, and identifying moments of impulsive or reactive behavior. Keep a journal, not just of your trades, but of your emotions during those trades. Ask, what did I feel when I entered the trade? Did I follow my rules? What emotion drove me to exit early or late? How did my previous trade affect the next one? Over time, patterns emerge. Perhaps fear surfaces after 2 losses, or perhaps you overtrade after a winning streak. Once you become aware, you can intervene. Detachment from money. One of the most paradoxical shifts in trading is learning to care less about money in order to make more of it. Professional traders view capital as a tool, not as identity, emotion, or self-worth. They detach from the outcome of individual trades and focus on the quality of execution. This detachment allows you to accept losses without panic, avoid chasing profits, stick to your plan regardless of recent performance. Your goal is not to win every trade. Your goal is to execute your edge with consistency over hundreds of trades. When you remove emotional attachment to each outcome, you begin to trade with power. Discipline over impulse. Impulses are fast. Discipline is slow and deliberate. When a setup forms, an amateur asks, "Can I make money?" A professional asks, "Does this meet my criteria?" The difference is massive. Discipline means only taking trades that meet your plan, respecting stop losses always, following your rules even when it feels uncomfortable, saying no to 90% of the market noise. It is easy to be disciplined after a win. The real test comes after a loss, or 3 in a row. This is where most traders self-destruct. Professionals stay consistent, not emotional. Heh, handling losses. Losses are part of the business. Even the best strategies will lose often. Successful traders expect to lose, and more importantly, they know how to lose. Here's how professionals handle losses. They size trades to absorb normal drawdowns. They never revenge trade. They use losses as feedback, not punishment. They maintain confidence in their system, not their ego. If you personalize every loss, trading will feel like emotional torture. If you internalize the idea that losses are statistical outcomes, you remain grounded. Developing mental resilience. Mental resilience means bouncing back after adversity without breaking down. Trading tests this constantly. Drawdowns, streaks of bad luck, technical errors, they all happen. Resilient traders take breaks when emotionally drained. Do not escalate losses with poor decisions. Focus on process, not perfection. Return to fundamentals after tough sessions. Building this resilience takes time, but it is the only way to survive long enough to thrive. Mindfulness and present moment awareness. Much of trading failure comes from being mentally in the past, regret, or the future, hope. Rarely are traders grounded in the present. Mindfulness training teaches you to observe your thoughts and emotions without acting on them. It helps create space between impulse and action. Practical exercises include breath awareness before market open, pausing for 5 seconds before every trade, using post-trade reflections to evaluate mental clarity, setting alerts or visual anchors that remind you to check your state. When you trade from the present moment, you are no longer hostage to fear, greed, or regret. You are simply executing your plan. Chat developing a trader's mindset. The trader's mindset is distinct from the average person's mindset. It is built on probability, not certainty, risk, not safety, statistics, not emotion. Here are key beliefs successful traders hold. My job is not to be right. It is to execute with consistency. Losses are a cost of doing business, not a reflection of my worth. I cannot control the market. I can control my behavior. One trade means nothing. 1,000 trades reveal my edge. By internalizing these beliefs, you condition yourself to operate like a pro. Confidence versus overconfidence. Confidence comes from preparation, backtesting, journaling, and evidence of repeatable results. It is stable and rational. Overconfidence comes from ego, recent wins, or fantasy. It is fragile and dangerous. A confident trader follows the plan. An overconfident trader breaks it because this one is special. Learn the difference. Confidence builds equity. Overconfidence burns it. Building emotional capital. Just like financial capital, you must manage your emotional capital. It is a finite resource. Burn it with frustration or stress, and you will make poor decisions. To preserve emotional capital, do not trade when tired or distracted. Avoid overtrading during volatility. Walk away after major emotional swings. Take mental health days when needed. Trading is not about maximizing screen time. It is about maximizing clarity and composure. Conclusion: your mind is your greatest edge. No strategy, indicator, or algorithm can protect you from yourself. Your thoughts, your emotions, and your reactions are your ultimate trading tools or your greatest liabilities. Mastering trading psychology is not a bonus skill. It is the core skill. If you want to trade for a living, study yourself as deeply as you study charts. Train your emotional discipline as rigorously as you train your setups. Respect your psychology as much as your capital. Because in the end, the market will test your mind more than your method, and only those who pass both tests will remain. Conclusion: trading is a profession, not a gamble. Day trading is not a game, and it is not a shortcut to wealth. It is a demanding profession that requires structure, focus, risk control, and emotional discipline. It takes time to learn, effort to master, and humility to grow. The market does not reward randomness, it rewards consistency. And consistency is built through a system, backed by preparation, executed with discipline, and reinforced by mindset. You do not have to be perfect. You have to be prepared. You do not have to win every trade. You have to manage every trade like a professional. You do not have to predict the future. You have to react to the present with clarity. Every successful trader once started as a beginner. The difference is that they treated trading like a business, not a lottery. They studied not just price action, but also themselves. They learned to think in probabilities, manage emotions, and stick to rules when the pressure was highest. If you commit to the process, refining your system, protecting your capital, and sharpening your mindset, you give yourself the greatest advantage of all: control over your own behavior in a market you cannot control. Join the mindset revolution. If you found value in this content, you are already on the path to becoming a serious trader. But the journey does not stop here. In fact, this is only the beginning. At Trading Mindset Lab, we focus on what truly separates professionals from amateurs: psychology, discipline, structure, and execution. No hype, no shortcuts, just real-world trading principles broken down and delivered by professionals. Subscribe to Trading Mindset Lab for weekly insights, deep dive videos, live breakdowns, and actionable lessons that sharpen both your strategy and your psychology. Whether you are a struggling beginner or a profitable trader refining your edge, this is your community. Your next level is not about more indicators. It is about mastering the one thing that matters most: your mindset. See you inside the lab. Let's trade like professionals.